Real estate analytics firm Radar Logic released its February home price numbers just a few moments ago, showing a drop of 4.3% from last February, with prices falling to just over $178 per square foot. That is the lowest number for the company's RPX index since March of 2003. Joining us to talk about this since the numbers were released is Radar Logic CEO Michael Fetter. Mike, good to have you back with us.
Hi, Carol.
So how bad is this decrease?
Well, I think what it really suggests is this is the time of year we would expect to see some strength in the market.
Spring, right? It's when people go out shopping.
Now, mind you, it's February, but with housing prices depressed, with the bargains abounding, one would have thought that the buyers would have come back out, and the trend is they didn't. So the concern we have is that it's really more of the same, that we're going to bounce along a little bit here, and that as we come into the spring and would typically expect to see some strength, it won't really be sustainable strength.
We've got a chart, though. The chart looks like we're kind of, though, leveling off here, bottoming out here. Is that not so?
Well, this time of year, you would typically see some bouncing along the bottom. The concern we have, if you go back to 2000, this time February 2000, and you plot a historic growth rate for housing, that would have brought the RPX without the bubble and without the bust to call it 235, 240 a square foot. We're at 178.
We got a chart up here. Just walk us through what we're seeing here.
Well, the yellow line reflects an estimate of what a normal trajectory of housing based on history might have been without the boom and then the bust. And as you can see, it's substantially above where the RPX line, which is the white graph, is appearing on that chart. The blue line is the trend line from February of 2009 to 2010 to 2011, and it's still negative.
A lot of people come on and say, Barton Biggs, for example, this is his one main concern, and he's bullish, right? When does your tone change? Because you've been telling us pretty much this for the past, I don't know, 6 months, year?
Even longer, yes.
Longer.
I think the real concern now, Matt, is that a house doesn't appear to be as good an investment as it used to. The psychology of a home buyer has changed. People who bought houses in the last 6 years have lost money on them. So until
now they buy houses to live in them rather than as an investment.
Well, but even the people who bought them to live in them over the last 6 years have lost money.
No, we actually did a story earlier in the week about how people are kind of reconsidering, even with prices low, that it's just not the investment it was. Let me ask you about something, though, also in your release, Michael. It's about home sales as measured by your transaction counts increased from January to February of 2011. But we need to be careful because a lot of this was what, foreclosures?
Well, the percent of total transactions that's distressed houses trading is upwards now of 40%. The discounts of those transactions to a normalized market is approaching 40%. The problem is that what you have are the real bottom fishers, the investment buyers, the all-cash buyers, and you know, you've got Toll Brothers and Beazer buying homes instead of building them with the specific intent of renting them. There's an ROI that works for the rent. Above that, people won't buy.
I have to ask you, though, the rate of decline can't be as bad as it has been the last 2 years, right? I mean, prices can't continue to come down at the pace that they had. It must be getting at least less worse.
Well, as you know, Matt, we don't forecast housing prices, but the concern we have is the supply side is so overwhelming relative to demand that sure they could. They certainly could.
They could continue on the same path.
There's no question. Until the supply and the demand begin to equalize, the pressure is downward.
But you say the solution is not to bring out, for example, bring forward the foreclosures, do them all now.
Matt, let's say you do bring them all forward and do them all now. Who's going to buy all those houses? That's the problem.
Listen, you also had some news this week, and I just want to bring it up, and this has to do with your RPX. It looks like what the CBOE is going to be in trading actually futures contracts on that index.
That's right. CBOE Futures Exchange announced on Tuesday that they're going to list contracts on the RPX Futures. So we'll be able to see what institutional investors think the RPX is going to be for the next 5 years. We'll be able to see it by regions for the next 3 or 4 years, and eventually, with some luck, they'll trade actual cities. So you'll get an idea of what the market thinks the direction is going to be.
You don't forecast prices. We'll be able to see what the institutions, what investors basically think going out through the futures use.
Right.
All right.
Excellent.
Got it. Michael, thank you so much. Good to get an update on housing. Michael Fetter, thank you so much.
Pleasure.